In every corner of the globe, from the neon-lit streets of New York to the vibrant bazaars of Mumbai, the unmistakable allure of a chilled Coca-Cola encapsulates not only a refreshing taste but also a monumental legacy of worldwide influence. As this global giant continues to dominate markets and shape cultural identities, it simultaneously grapples with the dynamic challenges of modern trade, where disrupting winds of economic shifts and evolving geopolitical landscapes signal both uncertainty and opportunity. This confluence of enduring brand heritage and emerging trade disruption sets the stage for an intricate dance between tradition and innovation, where the spirit of Coca-Cola meets the unpredictable currents of global commerce, inviting us to ponder how such a time-honored enterprise can remain resilient in the face of ever-changing trade winds. Coca-Cola has evolved a multifaceted strategy to navigate global trade challenges by balancing centralized brand consistency with agile local adaptations. From the outset, the company forged a unique franchising and bottling model that partners with regional operators, creating an asset-light yet robust distribution network capable of rapidly responding to local market disruptions and regulatory changes. Meanwhile, Coca-Cola's marketing strategy blends a universally recognizable brand image with localized messaging and product variations tailored to the cultural nuances of diverse markets, ensuring emotional resonance with consumers worldwide. Additionally, leveraging advanced analytics and an integrated supply chain network allows the company to optimize production, inventory, and logistics, turning potential trade vulnerabilities into opportunities for adaptation and growth. Trump's tariffs on aluminum, and by extension, other raw materials, disrupted Coca-Cola's established cost structure and supply chain dynamics, prompting the global giant to pivot its strategies in order to safeguard its profit margins and maintain operational agility. With aluminum prices poised to rise due to these tariffs, Coca-Cola reassessed its reliance on this material for its iconic cans and began exploring alternative packaging options, most notably increasing its emphasis on PET plastic bottles, which, although less sustainable, offer a cost-effective and flexible substitute. In addition to packaging shifts, the company implemented strategic sourcing practices by exploring domestic aluminum suppliers and enhancing its hedging programs to mitigate the impact of volatile input costs. These proactive adjustments not only helped buffer the immediate cost pressures from increased tariffs but also provided Coca-Cola with a more resilient and diversified supply chain, a necessary evolution in the face of an unpredictable global trade environment. Expanding on this, Coca-Cola's agile response exemplifies how multinational corporations can balance cost pressures against broader strategic objectives such as sustainability and market consistency. As such, the company's adaptations reflect a broader trend of trade policy-driven innovation, where challenges are transformed into opportunities for supply chain excellence and competitive advantage. Trump's tariff policy initially imposed a 25% tariff on imported aluminum with the goal of protecting domestic producers by making foreign-sourced aluminum more expensive. This measure was designed to boost local industry competitiveness and secure national defense interests by reducing reliance on imported metals. However, the policy also reverberated across global supply chains, challenging companies that depended heavily on aluminum as a primary material. For example, multinational beverage companies such as Coca-Cola, which rely on aluminum for their iconic cans, experienced rising production costs and were compelled to re-evaluate their sourcing strategies, explore alternative materials, or consider packaging innovations to counterbalance increased expenses. Ultimately, while the tariff sought to rebalance trade and reinforce domestic manufacturing, its impact underscored the complexities of integrating protectionist measures within a globally interconnected economy. Expanding on this, further inquiry might explore how industries re-engineered supply chains to manage similar disruptions, or how subsequent policy shifts and retaliatory measures influenced global trade dynamics.